Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation and needs. Welcome to another round of market updates in what has been a very eventful week. Today we will cover the record smashed in the S&P 500, US economic data coming in below expectations, trading psychology, and more intriguing central bank activity. The S&P 500 closed at record highs during the week as optimism over home sales and Fed stimulus provided much needed momentum. The benchmark index reached intraday highs of up to 1599, but closed just short of the 1600 level. Pending home sales also rose 1.5% in March, reversing February's decline and achieving the highest level in 3 years. Perhaps this may not be that surprising, since the last 3 years was still the aftermath of the GFC. Although pending home sales rose, complete sales fell in recent months, mostly due to the lack of supply. The number of homes up for sale has fallen approximately 17% in the past year. Apparently, this housing recovery is helping to boost economic growth as businesses get more work, and this creates more employment opportunities. Amidst a falling labor force, GDP, consumer welfare, rising debt, and artificial asset price increases, some still see this divergence between social welfare and the stock market as economic growth. Which begs the question, is the economy the stock market or the people? Following the records, the benchmark index was denied the elusive 1600 level on the back of this negative data. ISM manufacturing PMI came in at slightly below the expected 51 with a headline of 50.7. Now the good news is that it is above the 50 threshold for growth, but the bad news is that it is sliding fast and is perilously close to the below 50 contraction territory, which the Chicago PMI already achieved. In positive negative news, depending on whether your glass is half full or half empty person, the UK manufacturing PMI came in at 49.8, slightly below the 50 but above the forecast of 48.6. The ECB also cut its official interest rates from 0.75% to 0.5%. ECB President Mario Draghi stated that monetary policy will remain accommodative for as long as it needs to be. The euro rallied to 1.32 on some pre-announcement hype, but then plunged almost 200 pips on the back of the release. In trading psychology, short interest is a popular contrarian signal, as the rationale suggests that if everyone is selling, then the price is already at its low and can only move upwards, because eventually there will be significant upward pressure on the price as short sellers cover their positions. Short interest was at record highs in 2002, before the S&P 500 crashed to 800. Short interest again made a new high in 2008, just before the S&P 500 crashed again, and since then, while the S&P 500 has gone to record highs, short interest has flagged out to the same level as it was in 2007, which is 4-year lows. Interestingly, a Bloomberg report has suggested that 23% of central bankers surveyed said that they own shares and plan to buy more. Now this ranges from the Bank of Japan to the Bank of Israel. The Swiss National Bank also have equity holdings, as does the Czech National Bank. Of course, given the lack of transparency with central banks, it may be so that only 23% have so far admitted to owning equities. Now, how convenient is it that we know of this development right when the market could be in the grip of a bull trap at record highs? Now, the last time we mentioned that central banks were buying, which was gold, it crashed, not hinting at anything. That's all for this week. On behalf of Trading Pursuits, would like to wish you profitable trading.